Warren Buffett has spent over 70 years watching how the world's decisions turn into everyday people's problems, and recently he put it in a way that stopped a lot of people cold. He described what's happening right now in the Middle East not as a political story, but as a household finance story. A story about a thunderstorm that most Americans are watching from a coffee shop window, thinking it's somebody else's problem. His warning: that storm is already raining on your roof. Most people just haven't checked the ceiling yet. Today, we're going to walk through Buffett's framework for understanding exactly what the Iran conflict means for your wallet. Not the political spin, the economic mechanics, the numbers behind the headlines. And if you're serious about understanding what's really happening to your money right now, hit that subscribe button before we go any further. This channel exists for people who want to think clearly, not just feel informed. Here's what we're covering. First, what's actually happening with oil prices and why the data is more alarming than the headlines suggest. Second, who benefits from this conflict continuing and who's actually paying the bill? Buffett's answer to that question is uncomfortable. Third, 3 scenarios for where this goes and what a rational person should be doing right now. Let's get into it.
Start with the context. The war between the United States, Israel, and Iran began earlier this year. There was a ceasefire, fragile, but a ceasefire. Then both sides exchanged fire again. Trump called Iran's counterproposal a piece of garbage. Iran called American demands unreasonable. The U.S. proposal asked Iran to surrender 440 kilograms of highly enriched uranium, halt enrichment for 12 years, and reopen the Strait of Hormuz. Sanctions relief in return. Both sides said no. Buffett's framework for moments like this is simple. Don't listen to the political language. Watch the numbers, because the numbers tell you what the headlines hide. So here are the numbers. Brent crude, the international oil benchmark, sat at $72 a barrel on February 27th of this year. At the peak of the conflict, it touched nearly $120. That's a move of more than 55% in a matter of weeks. In March alone, Brent rose 51%, one of the largest single-month moves in the history of oil markets. Today, with cautious signs of progress in negotiations, it's pulled back to around $100 a barrel, still nearly 40% above where it started. Gasoline at the pump hit a national average of $4.50 a gallon in mid-May, up over 43% from a year ago. Some states crossed $6. Now let's make this personal, the way Buffett always does. Take an ordinary American family. They drive 20,000 miles a year. Their car gets 25 miles to the gallon. That's 800 gallons of gasoline annually. A $1.50 increase per gallon is $1,200 a year. Gone. Not because they bought anything new, not because they made a bad decision, just because of what's happening in a waterway most Americans have never seen on a map. And gasoline is only the visible part. Diesel runs the trucks that bring food to your supermarket. Jet fuel runs the planes. Natural gas heats your home and powers a third of America's electricity. Every one of those prices is connected to crude oil. When energy costs go up, everything goes up, and the increase multiplies through every step of the supply chain before it reaches your kitchen table. Now here's the part that concerned Buffett most when looking at this situation. While oil was surging more than 50%, the S&P 500 hit an all-time intraday high on May 1st. Stocks at record levels, energy costs exploding, markets behaving as if those two things can coexist forever. An energy analyst quoted by CNBC described this as misplaced euphoria, warning that investors were sleepwalking toward a recession. Buffett has seen this pattern before. The markets eventually figure out what the rest of the economy already knows, and the longer it takes for that realization to arrive, the more violently it tends to arrive.
Drop a comment right now. Are you feeling higher energy costs in your daily life? Groceries, gas, utilities, tell us what you're seeing. And if this is helping you connect the dots, smash that like button.
Buffett's longtime partner Charlie Munger had a rule he repeated for decades. Show me the incentive, and I'll show you the outcome. Buffett has called it one of the most reliable tools in investing. Applied carefully, it cuts through almost any amount of political noise. So, let's apply it here. Who benefits from this conflict continuing? Oil producers benefit. When Brent goes from $72 to $100 plus, every producer, in the Gulf, in Texas, in Russia, collects a windfall they didn't earn through efficiency or innovation. They earned it through someone else's misfortune. Defense contractors benefit. Their order books are full for years ahead. Politicians on both sides benefit from looking tough. Toughness polls well. Compromise does not. And the leadership in Iran benefits from a foreign enemy that distracts from their own considerable troubles at home. Now the harder question. Who pays? The American family at the pump pays. The retiree on a fixed income, watching purchasing power erode, pays. The small business owner watching her electricity bill climb pays. The young couple trying to buy their first home pays. Because energy costs feed into inflation, and inflation keeps the Federal Reserve from cutting interest rates, and high rates keep mortgages out of reach. None of these people are in the negotiating room. None of them have a vote on whether the ceasefire holds. Buffett has a name for this dynamic: the most dangerous arrangement in any organization. When the person making the choice doesn't feel the cost of the choice, decisions get made carelessly. Not maliciously, carelessly. And carelessness, Buffett argues, is more expensive than malice over time. Because malice you can prepare for. Carelessness blindsides you.
Before we get to the three scenarios, and the second one is the one most investors are not prepared for, share this video with someone who needs to understand what's really happening right now. Not to panic them, to help them think clearly.
Buffett has called compounding the most powerful force in finance, and the most underestimated force in everyday life. Most people understand it when it works in their favor. $1 saved at a reasonable return becomes $10 over 30 years. What they forget is that compounding works in reverse, too. A 50-cent rise in gasoline isn't a 50-cent problem. It's a tax that multiplies quietly through every product on every shelf. The trucker pays more to deliver the bread. The bakery pays more to bake it. The grocery store pays more to refrigerate it. By the time that loaf reaches your kitchen table, the energy cost has become $1.50, paid by you, with no one ever sending you the bill in writing. Do that across every product in your life, across every month, across every year. That's what an energy shock actually does. And here's what Buffett finds most concerning about the current situation. Inflation, once embedded in an economy, is extraordinarily difficult to remove. The Federal Reserve spent 2 years and brought the U.S. economy to the edge of recession trying to squeeze out the last round of inflation. They were nearly finished, and now, driven by this conflict, we're potentially looking at another wave, not because of any domestic policy failure, but because a foreign policy decision hit the exact same pressure point the Fed was just starting to recover from. What does that mean practically? The Fed cannot cut rates the way the economy needs. Credit card debt stays expensive, mortgage rates stay elevated, household savings get slowly drained, not in one dramatic event, but month by month, year by year, like water through a leaking roof. Most people won't notice it happening until they look back 5 years from now and wonder where the money went. Buffett is famously skeptical of forecasts. He said repeatedly that anyone who claims to predict the future with confidence is selling something. But Buffett does believe in preparing for a range of outcomes. Not a single prediction, a disciplined set of scenarios. So here are 3. best case to worst case, and we'll tell you which one the data currently points toward. Scenario 1. De-escalation. The best case. A modified deal gets signed. The Strait of Hormuz reopens fully. Oil drifts back toward $75 to $80. Inflation pressure eases. The Fed cuts rates. Mortgages become more affordable. This is possible. Recent signs, talks continuing through Pakistani mediators, both sides signaling cautious progress, suggest it's not off the table. But even in this scenario, the damage already done to household budgets is real. That $1,200 per family in extra gas costs doesn't come back. The embedded inflation in grocery and utility prices doesn't instantly reverse. De-escalation is good news. It's not a reset button. Scenario 2. Frozen conflict. This is the scenario Buffett's framework assigns the highest probability to, and the one most investors are not pricing in. No peace. No full-scale escalation. Just a permanent, unresolved tension with oil flowing at reduced capacity and a risk premium baked into every barrel. Oil settles in the $90 to $100 range and stays there. Inflation stays sticky. The Fed can't cut rates the way the economy needs. Mortgages stay expensive. Credit card rates stay punishing. Household savings get slowly drained. And here's the insidious part about this scenario. It's invisible. There's no single dramatic event to point to, no crash, no crisis headline. Just a quiet, grinding erosion of purchasing power year after year, while markets largely hold their levels. The people who get hurt most in this scenario are the ones who aren't paying attention, who felt fine in 2026 because their portfolio looked okay, without realizing the real cost was happening in their grocery receipts and utility bills. Scenario 3. Full escalation. The tail risk. Not the most likely outcome, but not so remote that a rational person should ignore it. The Strait of Hormuz closes meaningfully. Oil tests $150 or higher. Brent already briefly surged past $126 in late April before pulling back, which tells you the market knows this risk is real. Gasoline crosses $6 nationally. Recession follows. Unemployment rises. The stock market gives back 2 or 3 years of gains in weeks. Buffett's framework on tail risks. You don't predict them. You make sure you can survive them. Margin of safety isn't just an investing concept. It's a household finance concept.
Which scenario do you think is most likely? Drop it in the comments, 1, 2, or 3. If this breakdown is helping you think differently, hit that like button.
Here's the honest conclusion when you apply Buffett's framework to everything we've just covered. You cannot vote on what happens in Tehran. You cannot rewrite the incentives of the people in that negotiating room. You cannot control whether the ceasefire holds. But Buffett has always drawn a sharp line between what's inside your circle of control and what isn't. And the discipline to know the difference, he argues, is worth more than almost any investment insight. So here's what is inside your circle of control. First, live below your means. An energy shock is a stress test on every household's financial margin. The families with margin absorb the shock. The families running right at the edge feel every dollar. Second, hold productive assets. Real businesses with pricing power that can pass rising costs on to customers. In an inflationary environment, ownership matters more than cash sitting still. Third, avoid what Buffett calls the great destroyer of household wealth. Panic at the bottom, euphoria at the top. That's the mechanism by which ordinary people transfer their savings to people who don't panic. If you're looking at where to focus right now, in order of priority, 1. Your energy costs. Know exactly how much more you're spending. Make it visible. Invisible costs compound invisibly. 2. Your high-rate debt. In a high-rate environment, reducing expensive debt is one of the highest return moves available to most households. 3. Your exposure to rate-sensitive assets. If rates stay higher for longer, long-duration bonds and highly leveraged companies face continued headwinds. This is analysis, not financial advice. Every person's situation is different. Always consult a qualified professional before making investment decisions. What Buffett's framework gives you is a way of thinking, not a set of instructions. The thinking is yours to apply. The world will always provide reasons to be afraid. What separates the people who build real wealth from the people who constantly feel behind isn't intelligence. It isn't luck. It's the discipline to think clearly when everyone around them is thinking emotionally. That discipline, calm, rational thinking in the middle of uncertainty, is the one asset no oil price, no foreign policy decision, and no market swing can ever take away from you.
Do 3 things before you go. First, smash that like button. If this breakdown helped you see what's happening more clearly, that's the simplest way to support this channel. Second, subscribe and hit the bell. We publish content for people who take their financial future seriously. If that's you, you belong here. Third, leave a comment. Which scenario do you think plays out? And what's the biggest financial impact you're personally feeling right now? Let's have a real conversation below. Next, we're breaking down which sectors of the market have historically outperformed during energy shocks, and which ones get quietly destroyed. That's a video you don't want to miss. See you there.